Ever wondered how much house you can afford on your yearly salary? Today we're going to break that down. It's a question that's puzzled many, but knowing the answer is crucial before you even think about buying a home. We'll delve into how your income affects your home affordability, the role of bank loans, property tax, interest rates, and even the significance of pre-tax income. Because, let's face it, understanding your home affordability is the first step to making a wise and sustainable financial decision. The first thing to consider when calculating home affordability is your yearly salary. Yes, your hard-earned paychecks play a pivotal role in determining how much abode you can actually afford. It's the starting point of your home buying journey. Now, you might wonder, how does my annual income tie into this? Well, it's quite simple, really. Imagine your yearly salary as the foundation of a house. The stronger and bigger the foundation, the larger the house that can be built on it. Similarly, the higher your yearly salary, the more expensive the home you can afford. But there's a rule of thumb to keep in mind. It's suggested that the price of your home should cost no more than 2.5 to 3 times your annual income. For instance, if you're making $50,000 a year, you should ideally look for homes that cost around $125,000 to $150,000. It's a ballpark figure, not set in stone, but it's a useful guideline to prevent you from biting off more mortgage than you can chew. However, let's not forget, your salary isn't the only factor in play here. Your existing debts, credit score, and the amount you have saved for a down payment will also significantly influence the price range of homes you can realistically afford. Also, don't forget about the ongoing costs associated with homeownership. There's property tax, homeowners insurance, maintenance, and possibly homeowner association fees. These can add up and need to be factored into your budget from the get-go. So, while your yearly salary is a significant piece of the puzzle, it's not the whole picture. It can guide you towards a price range, but it's equally important to consider your financial comfort zone and your future financial goals. Remember, this is a rough guide. Other factors will affect your home affordability. It's not just about how much house you can buy, but how much house you can afford while still living comfortably and meeting your other financial obligations and goals. So tread wisely. The next factor to consider is the amount of loan you can get from banks. This isn't as straightforward as it might initially appear, but don't worry, we'll break it down for you. Banks, in essence, are businesses. Like any business, they want to ensure that they're making a safe investment when they lend money. They do this by examining a few key factors. First up is your credit score. This 3-digit number is like a financial report card, showing how responsible you are with credit. A high score can open doors to larger loans and better interest rates. Next, banks will look at your debt-to-income ratio. This is a comparison of how much money you owe to how much you're bringing in. If you're buried under a mountain of debt, banks may be hesitant to lend you more. Conversely, if your debt is low compared to your income, you're seen as less of a risk, so banks may be more willing to extend a larger loan. The last major factor is your down payment. The more money you're able to put down up front, the less you'll need to borrow. This reduces the bank's risk and can increase the amount they're willing to loan you. And remember, a larger loan means a more expensive house is within your reach. But it's important not to lose sight of the big picture. Even if a bank is willing to lend you a large amount, you need to make sure you can comfortably afford the repayments. A dream home can quickly become a nightmare if you're drowning in debt. So, in essence, to maximize your potential loan amount, you need a good credit score, a low debt-to-income ratio, and a substantial down payment. But above all, you need to ensure that you can realistically afford the repayments. Understanding your potential loan amount gives you a more accurate picture of your home affordability. Remember, a house is not just a home, it's an investment, and like any investment, it requires careful planning and consideration. Now, let's not forget about property tax and interest rates. These two elements can play a significant role in your monthly payments and overall home affordability. Property tax is a levy on property that the owner is required to pay. It's typically a percentage of the home's assessed value, which can vary widely depending on the location. In some areas you might pay a few $100s a year. In others, you could be looking at several thousand. Interest rates, on the other hand, are the cost of borrowing money. When you take out a mortgage to buy a house, you're essentially borrowing money from a lender, and they're charging you for the privilege. The rate you're charged can dramatically affect your monthly payments. A difference of just 1 percentage point on a 30-year mortgage can translate into tens of thousands of dollars over the life of the loan. So, how do you estimate these costs? First, for property taxes, check with the local tax assessor's office or online resources. They can provide information on the tax rate in your area. For interest rates, it gets a little trickier. These fluctuate based on a variety of factors, including the overall economy and your personal credit score. However, you can get a general idea of what to expect by looking at current mortgage rates. Keep in mind these rates can change between the time you start house hunting and when you close on a property, so it's essential to stay informed and flexible. Remember, these are just two pieces of the puzzle. Other costs like insurance, maintenance, and utilities can also impact your monthly payments and overall home affordability. When you're calculating how much house you can afford, don't overlook these elements. They might not be as exciting as picking out your dream kitchen or choosing the perfect neighborhood, but they're critically important to your financial health and happiness in your new home. Always factor in property tax and interest rates when calculating your home affordability. Because at the end of the day, it's not just about how much house you can buy, it's about how much house you can comfortably afford. Lastly, it's important to consider your pre-tax income and the concept of living within your means. Now, what does that mean? Well, your pre-tax income is the total income you earn before any taxes are deducted. This is an important figure to consider when calculating how much house you can afford. Let's break it down a bit. Think of your pre-tax income as a pie, and each slice represents a financial obligation, from mortgage payments to groceries. Now, if you buy a house that's too expensive, the mortgage slice becomes so big that it leaves less room for other slices. And nobody likes a pie that's all crust and no filling, right? Remember, a mortgage isn't the only expense that comes with home ownership. You'll also need to account for maintenance costs, property taxes, and potential emergencies. So, if your mortgage payments are taking up too much of your pre-tax income, you might end up living paycheck to paycheck, which is not a sustainable or stress-free way to live. This brings us to another crucial topic: living within your means. In a nutshell, this means spending less than you earn. It's about making mindful decisions about where your money goes, ensuring your needs are met before your wants. Why is this important? Well, living within your means allows you to save for the future, build an emergency fund, and enjoy financial security. It's not about depriving yourself of everything you want, but rather about achieving a balance between what you want now and what you might need in the future. So, when it comes to buying a house, it's not just about whether you can make the mortgage payments. It's also about whether you can comfortably afford these payments while also meeting your other financial obligations and saving for the future. Remember, a home should be a place of security and comfort, not a source of financial stress. So before you sign on the dotted line, make sure you've considered your pre-tax income and whether you're truly living within your means. Your pre-tax income and lifestyle choices play a significant role in determining how much house you can afford. So, how much house can you afford on your salary? Well, it depends. Indeed, the process of determining home affordability is not as simple as it seems. It's a complex weave of multiple factors, all of which need to be taken into consideration. Your yearly salary is a starting point, but it's far from the whole picture. It provides a ballpark figure of what you might be able to afford, but the actual amount will depend on other elements. Then, there's the matter of bank loans. These can significantly expand your purchasing power, but they also come with their own set of challenges and considerations. Interest rates, repayment terms, and your credit score will all play a role in determining the size and conditions of the loan you can secure. Property taxes and interest rates are another part of the equation. These ongoing costs can add up over time and have a significant impact on the overall affordability of a home. It's essential to factor these in when calculating your potential monthly expenses. And let's not forget about pre-tax income and the importance of living within your means. It's always crucial to ensure that your mortgage payments, along with your other expenses, won't stretch your budget to breaking point. After all, a home should be a place of comfort, not a source of stress. Remember, home affordability is about more than just the purchase price. It's about making a financial decision that you can sustain in the long term.